Hello guys. I post this video for my family, which includes you. So that's my family, that social media family, as well as my clients. This particular video actually is something that it's about trust, and I received an inquiry about it. I've actually received several questions from multiple different clients, not a ton of them, but a few, on trust. And this is as a result, because of a ton of YouTube information that's out there currently about trust. So many of you may not know me, but my name is Kedra Flowers. I've been a CPA for just under 30 years. I have serviced all levels of businesses, most industries, especially high income professionals, doctors, attorneys, and so forth. But let me just tell you a little bit about CPAs in general, or any of those professional expertise. Just like your physician or your surgeon or whatever, medical school is huge. Okay. The tax code is huge. FASB, the Financial Accounting Standards Boards and regulations are vast, right? So you're going to have to reach far and wide to find a single CPA or a single attorney or a single professional that can address every single concern. So my recommendation is always to have a team. So you have your CPA who specializes in tax strategy, and that if you have IRS issues, you find a CPA who specializes in tax relief and tax resolution. If everything's great and you're high income and you're building businesses and trying to find tax effective ways to transfer wealth, then you want a team comprised of CPAs and attorneys that are abreast in wealth transfer and estate and trust taxation. Okay, so these are all unique specialties. And there's also kind of the general practice CPA. And so that's probably what you're going to run across most of the time when people say, or I'm not going to say run across, most of the time when people say get a CPA, that's what people assume they're talking about. So they just go and they Google and they look up whatever, and so forth, which, and then they select someone. If that CPA is licensed and that CPA is practicing and that CPA has clients and has great reviews and great testimonies, then they're like, okay, this is the person, this is the be all end all of all my questions. And I'm going to say for me, because I can't speak for any other CPA, for me, that's not me. You need a team of people. And I'm not afraid to tell you that I don't know it all. And I am not interested in learning everything to know it all. But in 20, almost 30 years, I don't want to give my age away, in all of this time, I will say, since 96, 93, when I started with Arthur Andersen, I've had exposure to a lot, from audit to tax to different industries and so forth. So I have seen a little of everything, right? But I specialize in certain things and I like to stick with that. With that being said, I do want to address and offer to you, if you're watching this video and you don't have a CPA or whatever, I do want to use the knowledge that I do have to provide some guidance to you on how to navigate this new YouTube university, Instagram university, where everybody's trying to get you to hire them to coach you in doing all of these things, right? So I want to make myself available to give you a little bit of guidance in next steps. This is not a private consultation. I will add a link in the somewhere following this video. If not, you can visit my website, which is definitely going to be in here. But I will add a link if you want a tax planning session or a specific consultation on your issue. That is going to be paid. That is paid at my current hourly rate. And that is what's going to show in the link that you're going to click. And it's the same link anybody else would get, right? Okay, so that's there if you want a personal and customized assessment. But I am going to give categorically generalized information in this video that will guide you so that at least you'll know whether you need to look further or keep scrolling. Okay? So that's really the information. And I'm not just going to give it from me. I'm also taking a moment to pull up a couple of other things that I might throw in here, and some stuff from a tax library, just to give you some guidance, because I imagine I use YouTube University for things if I need to replace a garbage disposal or whatever, and I don't know what I don't know about that. Okay, but guess what? There's some things I need to call a plumber for. I'm not going to try to do that. I had something floating up out my toilet one time, and it looked like a reptile, but it was something that was, I don't know. But anyway, I called a plumber. I didn't go on YouTube to figure out what to do with that because I didn't want to wake up and something is in my bathroom. So all of those things to say, we've got to use a little bit of, I don't call any of that stuff common sense because it's not common. This is very specific information. So with that being said, let's look at the video that brought you here. Okay, so this was sent to me by a client, so let's go ahead and get that to show up here. All right, so let's just watch. This was sent by a client that I'm going to provide a generalized categorical response to.
And as always, like and comment for more tips.
Here's why you need a trust before December 31st.
December 31st marks the end of this tax year. Why is this important? The tax powers of a trust go beyond the current year, but are limited to the prior year. With the trust, you can deduct 50% of your personal taxable income. So if I made $200K this year, that means I can deduct $100K from my income. It's no secret that I can currently amend my taxes to correct this with the trust. However, you can go back 1 year prior and amend those as well. So let's say I made $200K last year as well. I can amend that prior year, 21, and get those tax savings. I say you need to do this before December 31st because once December 31st hits, the tax year will be over and you will no longer have access to those 2021 benefits. If you wait till December 31st, you will have limited yourself to only tax savings for 2022 and 23. Whereas if you did it now, before the tax year ends, you get all for a year. If you want to know more about trusts, take a look at my page. I have a ton of content on what trusts are and how they can work for you. Don't wait to get a trust.
Okay, so now I'm just going to go through each little part. Now, let me just say, I do not know. This is a beautiful sister. She is gorgeous. I don't know her. I don't know her personally. This is not as a matter of fact, I'm not even going to say whether or not, because I don't know what she's talking about from there. Like, I don't know specifically what she's presenting. And I would venture to say anybody else watching, because she's not saying, right? And that's intentional, right? That's intentional. This is called marketing. So I am, and we're going to talk about the specifics of the trust too. And we're going to get that answered for you. But just understand the intent of these social media videos, which I do as well. If you go to Confidential Tax Relief, you're going to see them out there. If you go to Dreams Fulfilled Coaching, you're going to see them out there. These informational videos are based on some concept of truth in a lot of cases. Now, not all cases, but in a lot of cases. And what you need to do, because what I want to provide is some guidance on how to maneuver through all of this information. The thing that happens oftentimes is, or with me, is someone may forward that to me and say, hey, is this real? Well, I don't even know what specifically she's speaking of, right? Because this is very general. Now, I can tell you categorically, if you are a W-2 employee and you get wages, and those wages are are paid to you, you cannot redirect those earnings into a trust. Okay, not W-2. So, wages, salaries, W-2 employees, people paying the highest amount of tax in a lot of cases. This is not an option for you. I will say for most people, this option is not going to achieve whatever she's saying. And again, I don't know the specifics on what she's saying, but let's just go through each thing, because I don't want to talk. Well, I am going to talk categorically, but let's just go through.
Link in my bio for consultation. And as always, like and comment for more tips.
Here's why you need a trust before December 31st.
December 31st marks the end of this tax year. Why is this important? The tax powers of a trust go beyond the current year, but are limited to the prior year.
Okay. In general, categorically speaking, if you create a trust in the current year, that is valid. That would be any entity, not just a trust. That would be a trust. That would be an estate. That would be a corporation. That would be an LLC. Any entity that's created in the current year has the benefit of tax strategization or tax strategizing. That is strategization. That's my word. So I'm trademarking that on YouTube right now. But tax I can't even say it now. I'm being silly. I'm not. Let's be serious. Okay. You can strategize in the current year based on the entity that's in that particular year. Okay, so that is a valid statement. So I can say that. Now, again, she hasn't said specifically what kind of trust, but just on that part, that December 31st is the cutoff for whatever you're going to be doing in the current year.
With the trust, you can deduct 50% of your personal taxable income.
Okay, that gets a little dicey. That's actually extremely, that of all the statements made, categorically speaking, that is the one that causes the most pause for me. So without knowing, I haven't had a consultation. And here is the point that I want to make. And we're going to go through a couple of things here, but like, if I'm guiding you on what to do, you want to look at who's saying it. So, this person is an accountant and a notary public. Okay. And they have some followers who are following, them, and so typically, setting up a trust and providing tax strategy would be some combination. And again, I say a team. I don't say one person. Now, could I do a lot of? Yeah, I've done some of those things for myself personally. Of course, you can do them personally, and someone can learn. And someone could have worked for a CPA or an attorney, and they know how to do some forms. And again, you got Rocket Lawyer. You got all of these places, LegalZoom, where you can go and set up all this stuff. But here's the thing. That's 6 years of school that someone went through, which I'm not even saying that that's the best system, but that's the only system we have in order to get that license, that state regulation in order to maintain that license, that continuing education in order to continue to give that license. And in my case, as a continuing education teacher and sponsor, there's an additional license to teach. Okay. So what I'm saying about that is it's okay you're going to see the stuff on YouTube if you're searching it, right? So if I just went and I searched, how to avoid taxes, then I'm going to get a whole bunch of stuff. The purpose of these marketing videos is to get you to click the link, hire them. So you're paying them or you're having the consult, and they're going to do some presentation for you, hopefully that sells you, and you decide to hire them to handle that. The biggest thing that I would say before that is do your research. Do some research the person, research the website, just scroll down on the page. What are we talking about? Answering your questions. An ignorance tax. That's actually a really good one. If you haven't heard of the ignorance tax is something that you pay because you just didn't know any better. And so sometimes on YouTube, you're going to pay the ignorance tax because you just don't know any better, right? And so one place that you can go that you can feel a little bit more certain that you won't necessarily pay an ignorance tax is to a professional who is licensed. Does that mean that we have a monopoly on information? No, it does not. But it does mean we've done enough work to get whatever master's degrees required for that, because most of them are requiring that at this point. We've done enough work to pass the exam because all licensed professions require that. We've done enough to pass continuing education and to stay active with our license. So there are things, just basic things that I would say you want to check out. And so when you're looking at whether to follow, click the link, or keep scrolling, maybe I would do that research first. And that way that can save you on paying the ignorance tax. But I'll tell you another thing. The ignorance tax can be expensive because you can end up paying $5,000 for a trust, and then you have to come and hire me for $5,000 when you're audited by the IRS because you have no clue what was done. And by the way, and I'm not saying that that's what's happening here. I'm just giving you, this is what I do. I do tax resolution. I do IRS offers and compromise. I do audit representation. And a lot of the representation as a matter of fact, most of the cases, unless it's something to do with, I owe millions because I just didn't pay taxes, even though, whatever, those are cases too. But most of the cases where we're talking about an audit that's coming back in six figures owing the IRS, it is because I used somebody to do my tax return and my tax strategy, and I have no clue what they did. And here is my point. If you don't have the education in and of yourself, because you can get the books and read it. You don't have to go to college to understand how to do a 1031 exchange or, set up a trust or the different types of trust. You can just get a book. You can go to the library and just read a book if you don't want to buy a book. So there's information out there. Okay. And so but what happens is people want the easy way and they go through and they zip, and that will get you the ignorance tax. But with that, let me just start here because I know that's not why you're here. You're here to get the answer as to whether or not you can defer half of your personal income. Let's finish this and then I'm going to go to the next little screen.
So if I made $200K this year, that means I can deduct $100K from my income. It's no secret that I can currently amend my taxes to correct this with the trust. However, you can go back 1 year prior and amend those as well. So let's say I made $200K last year as well. I can amend that prior year, 21, and get those tax savings. I say you need to do this before December 31st.
Okay, I'm stopping there. I'm saying categorically speaking, that does not apply to anyone that I know. Now, what I would be interested to know, but I'm not going to spend my time or money doing it, is what is going to be presented in that consultation. So if you are the client that sent me this, I recommend that you go in and get the consultation. Hopefully it's free. So they can present to you all the stuff and whatever. And then once you have all that, now we can have an intelligent conversation and you can book a link and we can do a tax planning session. And I don't want to say the price of it because it might be different by the time you're ready. It's $350. I don't mind saying it's $350. But at the end of the day, it might be different by the time you see this video. Who knows? But that tax strategy session, you would need to have all the information for me to tell you whether or not this is something valid. Categorically speaking, I would caution you before even going, but you could save yourself some time. Figure out where the education came from. She says click on her page and see all this stuff and whatever. Now here's the thing, because YouTube University is so vast with information. Honestly, I could show you here. Let me just do that real quick. I'm going to show you another video. Here's another one. Let's go back. Let's go to the front of here. Okay, let's see. Okay, let's see. This is another one I pulled up. Here's another one.
Is being able to pay less in taxes. Now, in one of my previous videos, we talked about the 1031 exchange, which is a way to defer paying taxes. But what happens?
That's a real deal.
The 1031.
By the way, 1031 exchange is in the tax code. Okay, this 50% personal income deductible trust is not something in the tax code. That's why I'm saying. I guess I should have said that in the beginning. But but the point is, it's not there. You're not going to be able to search the tax code and find that. Okay. And so that is where it's paused. So now we've got to the only thing we can do is determine the experience, expertise, and education of the person presenting the information. So that's where I would start with that. But this is just another one.
One exchange doesn't work. Maybe we couldn't identify a property in 45 days, or maybe we couldn't close in 180 days. Or maybe we're getting older and we just don't want to buy another property. Well, there's one other commonly known way to defer capital gains taxes, and that's through a deferred sales trust. So in this video, we're going to talk about exactly what it is, and maybe you can take some of these things and apply it to your strategy.
Okay, I'm going to stop there because we're not going to go. You can go look at the whole video, whatever. I'm not categorically speaking, not validating or anything on that. I validate what I can see in the code. 1031 exchange is in the code. Deferred sales trust. The trust is a entity. It is a taxable entity, and it is an entity that can be used for tax strategy. It can. The specifics of it and how it's set up are very particular. So let's do this. So there we are with that. Just want to show you there's a ton. I think I did a Google search that said defer income using trusts or something, just to show, and I thought that was going to show all the different pages, but it didn't there. So that's fine. Okay. So now let's go back to we're not going to go to him just yet. So let's do this. He went to AI. This is just Bing. How to use trust to reduce your income tax. To use a trust to reduce income tax, you can, and I'm going to say yeah or nay categorically if I agree with this. You can direct your earnings into a trust. You can do that if you have business income or investment income producing assets. That's real property, rental property, commercial rental, commercial real estate, businesses. Yes. Okay. So yes, so this is just going through just a general search. Okay. Now these cannot be wage and salary earnings. Okay. I think I said that earlier. No, they cannot. It's generally going to be business or investment income. Structured trust. So they distribute income to beneficiaries. Okay. So remember, this says to use the trust to reduce tax. So this is specifically how, if you're trying to do that. So you would be setting up a trust with your business or whatever income. This is not advice. I'm just pulling up information and kind of going, either I agree with it or not. I'll tell you if I don't. Doesn't mean I don't know everything, but I'm just giving you, doing this a long time. Okay. So I'm gonna, I think I might have a little bit more experience than just the average person, but I still don't know everything. Right? I don't. Okay. So anyway, you can structure the trust so that they distribute income to beneficiaries. Now, as a matter of fact, not only can you do that to reduce some tax, you would have to do that. And let me show you why. Let's go into the tax library, which is fun. So let's say, I thought I had, okay, hold on. Let me find it. Here we go. Okay, here we go. Just to give you an idea. So on the right here, the Bloomberg, this is my tax library. Let's see if I can make this a little larger here. Okay. So if we were just looking at 2023 tax year, and we're looking at the tax rate, individual tax rate versus the trust tax rate. Because remember, the whole concept we're talking about is whether you can reduce your income tax by moving that 1/2 of your personal income into a trust. That's how it was stated. Now that, again, these are sales-based videos. So that doesn't mean that's what she meant. When you click in and get the consult, she might correct and say all kind of different stuff. But that's what was stated in the video. So that's why I just want to make sure you understand. First off, there's multiple different types of trusts. But it doesn't matter what type of trust. The 2023 tax year income tax rate for trusts on the first $2,900 that's taxable to the trust income, is subject to a 10% tax rate. Okay, so let's look at your $2,900. Let's look at your individual tax return. Up to $11,000, your income tax rate is 10%. So That's over 4 times the amount of income that you get at that 10% rate, right? Be a trust. So in other words, you're going to hit income tax rates a lot faster on the trust. And I'm going to shorten this. We're not going to drag this out. So at $2,900 up to $10,000, you're at the 24% tax rate. Look at individuals. You have up to $95,000 in income before you're going to hit that 24%. And then 35% is up to 14 or under 14,000. And then 37%, which is the max individual tax rate. Now, for an individual person to hit that top tax rate of 37%, your taxable income has to be $578,125. So if you're asking me about whether putting your money in a trust, your income in a trust, and flowing that income through the trust is going to cut off half your taxes. I mean, just on that. Think about this. So you'd have to get over almost $600,000 before you're going to hit that top rate as an individual. And that's after taking away different deductions and so forth. With the trust, it's $14,450. Much lower. You're hitting that. So in other words, the tax code is designed that you can't just move your money in the trust and avoid taxes. The tax code is designed to collect income taxes. If there is a strategy that would have that work like that, everybody be doing it. Okay. So I just want to throw that, but that's still not my answer. So you just got to stay with me here. Cause I want you to understand not just the, like picking up, she's saying I'm not saying it's BS. I'm not saying that. I'm saying you don't have enough information. So I'm telling you what you need to do in order to, I just want to give you some basic information that you can use to be thinking about this, because there's a lot of people out here talking about trusts. Okay. And so it's important that it's set up correctly by a professional, which I would recommend an attorney. That would be what I would recommend. That doesn't mean a CPA cannot do it. A CPA definitely can do it. But just like I said, like your physician, you wouldn't go to a brain surgeon for arthritis, right? You wouldn't go to a general practice for doctor for brain surgery. Go to a specialist in whatever. So if it's a CPA, go to a CPA who specializes in trusts. Go to an attorney who specializes in trusts. So all I'm saying is use that same kind of logic to pick your professional, and understand that when you go to those specialized professionals, that's going to cost some money. They're not going to give you that information for free. That's intellectual property. It wasn't free to them. They had to go and pay for those years of school. They had to pay in money. They had to pay in loans. They had to pay in building their business. They had to pay in marketing. They had to pay in attention. Because trust me, everybody who went and got that degree was not paying attention. Just saying. They had to pay attention to really learn their craft and become experts. Okay. And so you do want to find an expert on that thing. Okay. Now, so there we go with that. So on the tax part, we've talked about that. Now let's go back up to, there was another point. I want to make sure that I hit all the little points that I wanted to get. So you see on the tax rate now, the point, I'm sorry. Let's go back to the little bean clip. That's where I wanted to go. Let's get back to it. Hold on. That it? Yeah. Okay. So we talked about, this is just the general, if you put it in Bing or Chat GPT, it's going to answer, but it's going to do a disclaimer and tell you, hey, this is not, but I'll tell you, this is the AI, OpenAI, Chat GPT, all that. It's a little bit more reliable. Not even a little bit. I say a lot more reliable than what you're going to see on YouTube and Instagram. And the reason why is it's going and finding the most relevant information that's available to it. Now, with ChatGPT, the most recent information is 2021. So if anything, tax code changes, whatever, after that won't be there. And it'll tell you that though. And that's what's wonderful, because it's going to give you that little disclaimer to say, hey, I only have access to information up to 2021. You know what I'm saying? So here's the thing. if you want to start anywhere, just start going up. Get you Chat GPT, Bart. What is Google's AI? Bart. Bing has this. I don't know if there's a name for this, but whatever it is, and let AI give you a general answer, and it'll give you a general answer that might be enough to kind of tell you, okay, like if you're a employee and you get wages and salary, you would know off the top, okay, this doesn't apply to me. Keep scrolling. You see what I'm saying? Now, here's the other option though. Just because it doesn't apply to you now doesn't mean you don't want the information, but you still want to make sure that you're selecting the professional or the person or the course or the book that can give you quality information based on experience, education, and expertise. Okay, those are the three things you want to be looking for. Okay, so because you can set up a structure that would work, and this is giving you kind of an example. So if you have business or investment income, you could structure your trust, because here's the thing: those trust rates are only based on income that remain in the trust. So trust is a holding vehicle that can then be used. You move that income into the assets, income producing assets into the trust. And then this is categorical. Okay, this is not my specialty, but I did have to take the course in school, and I've seen a little, and I've set some up, for myself, so I know a little bit, but this is categorical. So you could get assets. You can move those into the trust if they're income producing assets. They now produce income, and then you distribute that income to, if it's irrevocable, and I'm not even gonna go there. Get you an attorney or a trust attorney or whatever, or you can YouTube to understand the differences in trust. You can use AI to get the differences to understand, but then you need to find someone who specializes in that to help you know what kind you need to set up. Okay, so, but with that being said, that asset goes in there, income flows through. This is just in general how it works. Income comes into that trust, and you have until the end of the year, December 31, to distribute the income from that trust to avoid that max 37%. As a matter of fact, it's higher than that. Hold on. There was another screen I didn't even get to show y'all. Is this the one? Yeah. So this is section 6110, imposition of tax on estates and trusts. Federal income taxes are imposed on the taxable income of estates and trusts. Okay, so this is the tax code. This is the godfather of tax right here. This is the code, right? So this authorizes Congress to tax, or the Department of Treasury, Congress to tax us, the trusts and estates. Okay, Department of Treasury, IRS enforces the tax. Okay, so federal income taxes are imposed. So this is the law. So their trusts are taxable. Trusts and estates are subject to a compressed rate structure, which is what I just showed you. Compressed rate structure. So that is showing you where I showed you that at the end of the day, at $15,000, you're at the max individual tax rate for a trust. Okay. A compressed rate structure that taxes them at a considerably higher rate than other entities for comparable amounts of taxable income. Starting in tax years beginning after 2012, the net investment income of an estate or trust that is subject to tax in the highest rate bracket, which is the 37% tax bracket, is subject to an additional 3.8% tax. This has the effect of increasing the top rate within the trust, within the net investment income that's moved into the. So we're talking about, we said in trust, you have businesses, you can have income, business income, or investment income. So net investment income that's taxed to that estate has the effect of increasing the top rate to 40.8%. 40.8%. So the reason I'm saying this is not because I believe that my beautiful sister is trying to get you to move your money and sit it in a trust. There's nothing in what she said that implies that. But what I am saying is, if the person that you select to help you to do what whatever this strategy is that's going to be presented, which I do not know. I did not go on the page. I didn't watch any other videos. The person that's going to help you do this needs to understand and needs to be able to show you the tax code that they're using or have education, experience, and expertise that's verifiable through a licensed state board, through a history, through a firm that's a big, I don't know, what is it now, Big Four CPA or big whatever attorney firm. Like you there needs be some credible malpractice backed insurance behind what they're saying. Okay, let me just say that, because at the end of the day, if that's done wrong and you set that up and they don't do what needs to be done in order to do the distributions of income from that trust correctly, and that income is then reverted back and considered under audit to still be a part of the income and assets of that trust, and you're now taxed at 40.8. So instead of saving 50% of your personal taxable income, which I can't imagine how that's possible, but if it is, I'm not saying it ain't, because I ain't looked at all that. I didn't go through the consultation, but I can't imagine. But that promise here is saying, if you mess that up, you're fixing to pay 40.8%. And unless you're making 600,000, then we're talking about 600K in income. She's talking about 200K. You wouldn't even be even close to that trust rate on your personal tax return. Okay. So there is strategy. Strategy is available. People talk about Donald Trump and how he has strategists, but he's not finding them for free on Instagram. You know, and so the questions that I get and the people who email me or call, I began charging for the consultations because of a lot of this through my website, because you used to could just go to my website and schedule a free consultation. I had to start charging because this is the kind of stuff I'm getting. And so what happens is when they go to schedule and they have to pay that initial consult for that $200 for 30 minutes, they be like, I'm not finna ask her that question. And so if $200 is going to stop you from scheduling with someone who has education, experience, and expertise, then you probably are not in a position where you're going to benefit from the wealth strategy, or not even that. You're not even going to be willing to pay and possibly have an afford issue with paying for a trust attorney or a specialized CPA firm that's what they do is trust and estate tax. I'm just going to be real with you. Though you're not going to get those for free. You're not going to get those consults for free. This is free. Follow me here. Subscribe to me here. Send the video to me here. And then I'll do a video and we'll talk about it here, because it's going to benefit you and anyone else who's watching. And I'll share this with clients and whoever else so that everybody can get the benefit from the teaching that I'm doing here, which most of this teaching is not as much about the tax code as it is about just understanding how to move through the information overload that we have online, which I love. But you've got to use it with a filter. You've got to have a filter that a list of things that you apply to a reasonableness test before you just jump into this. And then to think, I had someone that I had a consult with, and this is when I was still doing them free. This is one of the reasons that changed. And they, one of the things they said was, I'm looking for a whole nother CPA, and this is a business. This isn't a one person thing. This is a business, multiple people. And, pretty good, they were generating money and everything. I mean, good money. And, said, I think I need to change CPAs. My CPA is jealous of me. And I said, well, why do you think that? And they said, because every time we come to him and we're trying to show him ways that we can save on taxes and we can each set up a LLC in our own name, and then we can avoid taxes. And have y'all seen TikTok? It's a little boy on there. Oh, I wish I had got that little boy. He go, bullshit. Like, Yeah, that's the bullshit moment. Your CPA is not jealous of you. Your CPA is trying to protect you from having to pay me $5,000, $7,500, $12,000, depending on what's going on in an audit that might go for the next 3 years because of some crazy thing you saw on Instagram or YouTube. That's what your CPA is trying to do. Because most of my referrals are coming from CPAs whose clients have done this stuff after they told them not to do it, and now they were like, I don't represent an audit. Let me send you to someone that's her thing. So yeah, that's it. Okay, so that's my piece on that. Well, stay with me because we still haven't got to the bottom line. But here's the best little video. I said I was gonna show this video because I just think I thought, he said it very well. This came up as well about when I said using trust to avoid the income. Oh, wait a minute. Before I do that, let's finish our thing. So you can direct your earnings into the trust. Or business income or investment income. You can structure the trust so that the distributable net income is distributed to beneficiaries. Okay, so of the trust, right? And now understand that this may be an effective way to help reduce taxes. If a couple of things. If the beneficiary's tax rate is less than yours, then it's going to save taxes. And if that beneficiary, but that beneficiary can't be you, because then it's coming right back on your tax return. So you're shifting income to someone else. Okay. And so it gets all kind of sticky in here because if I've heard another question. Well, can I use this thing to, my wife claim this percentage of income and I claim this because she doesn't have, her income rate is lower than mine and blah, blah, blah. And I'm like, well, if it's your wife, and you're filing joint, y'all on the same income rate. And if you're filing separate, then in Texas, it's community property. So we got to split it in half and you got to have, so you're still on the same income tax rate, but possibly losing some deductions because you're separating it. Now, and so just all kind of stuff that's being presented is not right. A lot of times that when people have that error or that thinking is because they've been working with someone who files one spouse head of household and the other spouse head of household. So this spouse makes $100,000 and is claiming no kids or a few kids, and then this spouse makes $20,000 is getting the earned income credit and claiming head of household. That is illegal. That's fraud. Be clear when these things, and that's the thing. Okay, so let's go back to the comment with the interview consult person who said that their CPA was jealous of them. So every time they presented something, he knocked it down, and because he just didn't, he was old and didn't, old and some other things they said, but for whatever reason, he didn't want them to have money. The people look like them, shouldn't have money, whatever the thought process behind that. And that can be your reason, but here, and I don't know. But at the end of the day, the tax law does not lie. And you can pretty much rely that, can CPAs be wrong? Yes, I don't know everything. But if you're comparing what this CPA is telling you versus or this certified financial planner is telling you, or this attorney's telling you, versus what this YouTube coach of the year is telling you. I'm not gonna encourage it. I'm not gonna encourage that. Okay, so let's go back to this. So you can direct your earnings, structure trust in a way so they distribute income to beneficiaries, which means that income is no longer yours. It's gone to the beneficiary. They now own it. Okay, this is the last point on that. I tell people all the time, if you want to pay zero taxes, make zero money. That's a way. So this is kind of that. Like, okay, so I'm going to give away my money to this person. So my tax return is going to show 50% less. Well, if you give away all your taxable income to over here, well, not give away, but you redirect all your taxable business income to this entity and you move that whole business over there, your taxable income goes to zero. So I guess maybe that is a way. You know what? I just said it. Yeah, you can. I guess if you are a business owner and you move 50% of the shares of stock of that business into that trust, so that income is now over here, but that is not saving on your personal tax. That's not personal. That's business tax. Yeah, it gets tricky. I mean, I guess if you're saying it's there's all kind of we're gonna leave that alone. Okay. But yes, if you want a personal I have a lot I can say. I'm just not going to get into that on YouTube. And then the other thing is everybody's tax situation is different. So I can say just categorically speaking all day long, but I need to know your specific situation. Is it possible that you could set up a business, transfer it into the trust, like I did Airbnbs, move them into a trust, and then allow the income to flow through the trust, and then you distribute it to multiple different beneficiaries of that trust, and that income is at all these different places, and so they're each only paying 25% of income on that 100% of income. But guess what? At the end of that has happened. But what are you're paying 25% on that 100% that business made? But guess how much you get to spend? 25% too, because that's what's being allocated to. Like, understand that the tax is going to move with the money. You don't get to move the tax and keep the money. That is not, just categorically speaking, not going to be supported by the tax code. I ain't gonna say anywhere, because I don't say any, ever, never. But that in general, categorically speaking, is not going to be supported by the tax code. Okay, number 3. Allow the trust income to be taxed on the beneficiary and not the trustee. So like I said, if the beneficiary's tax rate is less, then you can do this. This will allow the beneficiary's lower rates of tax to be utilized. And in the case of dividends, the 10% tax credit will be used. So in this situation, that, yes, if the beneficiary of that, so, this trusts are used oftentimes for wealthy individuals, wealthy families, and so forth, to do just that. It's to move income, because maybe their income is 10 million. 2 million. They're at the highest. So, and they're hardly ever going to be there, because that we know that with Trump. It's not hard, because their income is going to be in different entities, so that they're all not going to be hit. I mean, their personal income's not going to be at that level, right? But in the situation where that it is, and that is a strategy, there are wealth management companies that is what they do. So they're not. But if you call them and say, hey, what kind of trust can I set up to cut off my reduce 50% of my personal income? If they didn't hang up, they're going to dismiss you, because that is not a question you're going to ask. What you're going to do is call, and you're going to schedule a consult, and then they're going to say, okay, the initial consult is $2,500, and then we will apply this to the different, once we set up the trusts, we'll apply that to reduce the $10,000 fee that we do to get that done, and whatever. And then you're going to be like, wait, what? So my point is, and I'm being facetious, because I teach using humor. So I hope it's not offensive, but that's how I teach. So anyway, yeah. So here's the thing. Is this a strategy? Is this a tax saving strategy for high income and wealthy individuals? Yes, it is. Individuals whose high income and wealth is coming from business income and investment income. Not wealthy individuals who's a doctor who make $800,000 a year in W-2 income. It's not a strategy for them. Okay. So that's just in general on that. Now, not done. We're gonna top this off with this last little video. I think he does a great job. I like the way he put it. I didn't watch the whole video, and I don't know that I'm gonna play the whole. But I don't think it was that long though. What is it? 4 minutes or something? Yeah. I don't know what it was. How long was this? I didn't even. Oh, it's only 4 minutes. Let's maybe that's why I select. I was like, he says it in a nutshell. So let's go and listen to see what he's gonna say.
Hi, Lee Phillips here. I'm a lawyer. I do trusts. Let me talk to you about whether or not you can use a trust to defer taxes, to get out of taxes. And in fact, what brings this up is there's a bunch of people going around now selling a trust that says that, I can have the trust earn money on the assets that I put in the trust, and all of that money that these assets in the trust earns can be deferred indefinitely. I get to pick when I pay taxes on that. And the answer is no and hell no. Any other questions? Let me explain a little bit, but the answer is no and hell no.
Yeah, that's good.
There are two trusts that you can defer taxes with. One is under Section 401K of the IRS Code. The other one is under Section 408 of the IRS Code. Section 408 describes a trust. It's something that you know as an IRA. There are thousands of pages of IRS regulations and rules and crap associated with these two trusts. If I could set up a trust, a simple living revocable trust or an irrevocable trust or whatever kind of trust it was, and have that trust earn income and have it deferred until I decide to pay tax on it, and I can take it out at any time. I don't have to be 59 and a half or any of that crap. That'd be pretty cool, guys. But don't you think that there might not be a page or two in the IRS code that describe this type of thing? There's nothing. The promoters of this trust are going to quote IRS codes up the gazoo and tell you that it's absolutely perfect. No problem. Come on, guys. Go back and give me some logic. If I'm going to use a trust and avoid taxes, be able to defer my taxes as long as I want, there's got to be something specifically written in the IRS code on that. You can't bootstrap together 20 versions or provisions or sections of the IRS code and figure out this trust. It ain't going to work, guys. You're going to rue the day that the guy sold you this trust. Trust me. I've worked with the IRS. I'm a U.S. federal tax court attorney. And it ain't going to work. I'm going to warn you.
Told you I hadn't even looked at the whole video. I didn't know that. But I knew when I heard the first few seconds, a couple of minutes, I was like, hey, that is the answer. But but we're gonna let the attorney break that down. But anyway.
I'm just going to tell you, there is no trust that can allow you to defer taxes other than the standard trusts that you don't think of as trusts. You think of them as IRAs and 401k plans and stuff. But they are trusts, actually. And they allow you to defer income. There are hundreds, thousands of pages worth of stuff at the IRS written on these two code sections that allow you to create these trusts. There's no other trust that can do that. And to have the guy say you can do it is the answer is no and hell no. Now, I do have a lot of uses of trust. Trusts are cool things. Get my ebook, How to Use a Trust. Just click on the button and we can get you that easy. It's actually a cool read. It's a good book. And it outlines what you can and can't do with a trust in a way that you can sleep at night and be very happy. So get the ebook. Don't forget to subscribe and all of that garbage for us. And we will see you on our next version.
All right. So now we
if you look at the laws of energy, the first law of
sorry, wasn't trying to do that. Okay. Wanted to make sure that that was clear and that you were able to see that. I think that's pretty much the same thing that I was trying to break down for you. I do want you to just be cautious. It's okay to look. And I say, an educated client is my best client. I love clients who do their research, do their homework. But the difference between you or subscribers, whoever, doing the research, doing the homework, and then scheduling a consult with a professional for advisement as to whether this sounds right, is you've got to have all the information. So understand that watching this clip on YouTube, or not YouTube, but on Instagram or whatever, it's not going to give you all the information. So you're going to have to make the appointment and schedule and go through the consult. So if there's a fee for that, you're going to have to pay the cost of that fee for you to find out what this person is talking about. So here's the thing. If you have a pause and you don't want to pay this person the fee, that may be something telling you inside that that person might not have the answer to what you're looking for. So follow that, and just with the information you have, hey, I want to find out, schedule, call a trust and estate firm, or you can call your CPA, but hopefully this is just giving you that information. But your CPA may specialize in that, so you can ask that question. But they're still going to send you a bill at the end of that consultation. But it's worth it so that you either do or don't qualify. And if you don't, you know why you don't. So now you can set up your structure, your business entity, whatever, accordingly. If you have these types of incomes, to be able to benefit from the tax strategy, because tax strategy is a real thing and it is possible to save on taxes. But when it sounds too good to be true, in most cases it is too good to be true. So with that, I will continue. If you're not already a subscriber, please take a moment and subscribe. If you like this video, you just like. And if you didn't like it, don't dislike. Tell me in the comments. Either way, tell me if you liked it. Tell me what you liked. Tell me, if I irritated you with my little sense of humor. I mean, whatever you want to tell me, just tell me in the comments. Usually I try to read them and respond. And I will just keep an eye out. And like I said, hit subscribe, hit the little little bell button thingy, so that you can know when something else comes out, because it may be something that would affect you, and it may be something that might save you some money. It used to be in the olden days that people charge $300 for a session to coach you on how to do ABC. Now they're charging $3,000, $30,000, whatever, to coach you on ABC, and it still don't make it any more right. Just because it's ABC don't make it RIGHT. So just because it costs more doesn't make it RIGHT. It does not. So to me, the only thing I can tell you to do, it doesn't mean these are the only people that know the answer, but the best advice I can give you is look for education, expertise, and experience, or education, experience, and expertise. The way you can look, are they licensed? What's their history? What's their background? What's their bio? What firm are they a part of? Is it their own tax office? Kind of thing. That doesn't mean they don't know it. It just, you want to look at the whole picture. So with that being said, have a great day, and let me know if you like this. If you like this content, you'll get more of this content. If you don't, then guess what? I won't waste my time, because I'm trying to help, but if it doesn't help, it's a waste of my time. I don't want to waste your time. Have a great day. Bye-bye.